Good afternoon, everyone, and welcome to the 2021 Traders Playbook Market Strategies in a Pandemic-battered Economy. I'm Daniela Laurel, your host and moderator for this afternoon, and it is really my pleasure to be presenting to you guys our distinguished speakers, all of whom are, of course, experts in their respective fields. I have worked with a few of them over the years, and I'm very, very excited to be speaking with these people this morning. Now, we hope you guys stick around until the very end of this virtual briefing. They will be having their own individual segments, so we do hope you try and listen to each one of their presentations. They have very different expertise and value added. We will also be having a very exciting jam-packed panel discussion wherein we will be addressing a lot of the questions that you've already given, and you will have the opportunity to ask more questions. And of course, mini games and a grand raffle draw. You will have the chance to win up to 5,000 pesos worth of investment credit. So to officially start the program, may we invite everyone to please join us for a short prayer, followed by the Philippine national anthem.
Good afternoon. Let us all be in an attitude of prayer, putting ourselves in the presence of the Lord. Almighty Father, we would want to praise you and exalt you today. We are all in awe of your goodness and your amazing grace. We would want to praise you for reminding us that you are Lord over all and that you are in control. Thank you, Father, for giving us the opportunity to gather virtually through the gift of technology. Thank you for the wisdom and knowledge that you've bestowed upon the organizers of this Traders Playbook event, as well as the speakers that we have today. We continue to pray for protection against this COVID-19 virus. We pray for healing not just from this virus, but also from the other pains and struggles of this life. May we all look to you and be reminded that it is your grace alone that sustains us. We are grateful for this opportunity to gather, learn, and to become better Filipinos that can contribute to the well-being of our country, the Philippines. We entrust to you the outcome of this event. May you override all preparations, the internet connections of the speakers, organizers, as well as the attendees, presentations of the speakers, and all controls and flow of the program to be seamless. We lift up everything to you, and may this bring glory to your name. All these we ask in the mighty name of your Son, Jesus. Amen.
Once again, ladies and gentlemen, welcome to 2021 Traders Playbook Market Strategies in a Pandemic-battered Economy. So this is going to be an exciting and fruitful afternoon. Thank you for joining us. We know that it's a Sunday afternoon for everyone, but this will be a full afternoon full of market forecast discussions, especially analyses on how the economy and particularly the stock market may perform this 2021 and beyond. So buckle up. It's going to be a great ride. Meanwhile, should you need any technical assistance from our team here, you can see that on your screens right now. Simply type in your questions via the chat box, and we will do our best to respond to every question accordingly. You may also take this chance, and I really very much encourage you to do so. This is a rare opportunity, a limited event. Please use the chance to pick the brains of our speakers. Send in your questions. I hope to have a very live and very interactive question and answer discussion. This will be the most exciting part of the program. Don't just sit there. Do participate. And later, again, you can do this through the exact same feature. Type it in, and we will be accommodating and selecting some of the questions from the audience. We've also got, as I mentioned earlier, some pre-questions that we received by the Facebook page. So thank you so much for sending those in. Now, aside from intellectual discussions. We also want everyone to enjoy this opportunity. We have a lot of prizes in store for you guys this afternoon, and all you have to do is tune in and, of course, participate in our new normal interactive games between each session. So it doesn't have to be boring. It doesn't have to be all technical and all numbers. It can also be very fun, and you might actually have the opportunity to become a newbie investor. So, all right, let's start things off with a raffle. We love raffles here in First Metro. And if you want to join this e-raffle, of course, everybody's here to join. Just check in by clicking the pop-up that you're now seeing on your screen. So, this raffle is one of the first prizes that you will win. So, a lot of prizes in store. There will be 5 randomly chosen winners, okay? And they will be winning 7-Eleven vouchers worth 500 pesos each, okay? So please start clicking in. We need to see who is already on the stream to be able to participate in this first raffle draw. And while you guys are clicking away, just to break the ice, it's an event wherein we are trying to look forward to better things, but of course we need to assess. And I want to ask you guys, how would you describe your experience during the pandemic in one word? Let's just break the ice here. I just want to see what the sentiment is of all you guys out there. I mean, traders are always optimistic, but I do want to see how honest you are. Please write your answer there in the dialogue box. So we'll give you a few seconds to answer. But please do answer. Guys, don't be jahe, because I know that everybody's feeling very apprehensive. I think that's one word. I think challenging is another word to describe the pandemic experience. Yes, I can see some answers here. Overwhelming. I think that's something that we all have been feeling. And, anxious. I think anxious has been coming up. Tiring, really, yeah. It has been very tiring. I think a lot of people are very unsure. I think unsure is another word that I'm seeing here. So everybody, of course, has been through the same problems and issues. Our freedom has been taken away. We are uncertain. Our plans, everything that we used to enjoy and take for granted has been taken away from us. So undeniably, of course, this past year has been very challenging. Thank you for being honest with your answers. Even if we've tried very hard to be resilient, it's been a very, very tough past year. So now, the question is, okay, after almost 1 year of a lockdown, how do we move forward from here? And interestingly, we here at First Metro actually believe that one of the ways is to be able to be optimistic and be able to manage our finances and investments in a smart and intelligent way. I think this gives us a lot of comfort. It's something we can, of course, control. It's something that we can research on and get better at. So this is something that we hope to achieve in this session with the help of our resource speakers this afternoon. Now, back to our raffle, guys. I think you should be seeing a pop-up. I think that will display the first set of our winners. So congratulations to our first 5 lucky winners. You will be contacted by FirstMetro Securities at the end of the program. So you see, ang aga-aga pa lang, wala pang nangyayari, and you've already won gift certificates from 7-Eleven. So very, very exciting. Congratulations. We are only starting, so make sure to tune in for more. And of course, click those buttons and send in those questions. All right, guys. So without further ado, let's move on to the part that we've all been waiting for. I would, of course, like to introduce our first speaker for the afternoon. He is no stranger to First Metro. He's no stranger to our broadcast as well in Business World Live. He's, of course, one of the leading economists here in the Philippines, Dr. Alvin Ang. Dr. Ang is a professor of the Economics Department of the Ateneo de Manila University, and he's also a senior fellow of the Ateneo Eagle Watch. Here on now with his presentation, Philippine Economic Outlook for 2021, a breakout or more of the same. Let us all welcome Dr. Alvin Ang.
Good afternoon. This is Dr. Alvin Ang of the Ateneo de Manila University, Center for Economic Research and Development. I'll be sharing with you our economic outlook and forecast for 2021. And this presentation is entitled A Breakout or More of the Same for 2021. Before I begin to analyze the economy, I'd like to give you a certain analysis and feedback on what is expected and where growth will come from for 2021. So we're looking at the world economic recovery, we're looking at vaccines, we're going to analyze also how the economy fared last year and what are the sectors that are expected to grow and what are our estimates for 2021. First, let's look at the economic growth performance for 2021 of our neighboring countries. Because if we look at our economic activity of the Philippines, is basically 40% dependent on international trade. As you can see, it was more than 60% in the past. It has gone down to 40, but still it is significant because it means that 40% of the recovery in this pandemic is dependent on the recovery of other countries. And who are these countries? These countries in the past, in the 1990s, were mostly European economies and the United States, and a little of Southeast Asia and Japan. But the last few years and decades, this has changed. So basically, our interconnectivity in the global value chain is connected with China, with Southeast Asia, but still significantly connected with US and Europe, but not the same as it was in the past. And this interconnection is important because once they recover, they also pull up the economic performance of the Philippines. And as you can see also, these countries, they have about the main sources of our tourism, and they also have employ many of our OFWs. Now, I'm showing you a table of the performance of our global partners and how they were able to manage COVID in this pandemic situation. As you can see, I color-coded the performance, the good performance in red, and the challenging performance in green. Three performance per indicator are highlighted. As you can see, the Philippines has both two greens and two reds. So that means we also perform badly in two aspects, but we're also performing well in two aspects. Primarily, I want you to take a look at the GDP quarter-on-quarter growth because the Philippines actually posted a very strong 5.6% growth quarter-on-quarter, meaning from third quarter to fourth quarter of 2020. So that's a strong, confident performance. However, we are still lagging in other sectors and other economic data. So we'll go back to that and analyze it deeper as we go along. Now, our challenge basically in this recovery is handled and dependent on the availability of vaccines. So as we can see, the vaccines are not fully available for most of us right now. In fact, the Philippines still have to get a sizable amount of vaccine because they're of this time. So we're still waiting for the first batch to arrive. Now, the vaccines are important because without the vaccine, we will have to depend on herd immunity, which is scary. Yes, it can be shorter, but it can cause a lot of deaths, just like what happened during the 1919 flu, where about 50 million people died. And yet, in 2 years, the pandemic was gone. So we don't want that. That's why we have a race for the vaccine, and we have seen many countries trying to produce the vaccine already as fast as they can. And in fact, the supply now is not enough for the rest. And this is the reason why we assume perfect logistics, that if all the vaccine supply is available, there's enough resources for every country, and there is no problem transporting them, we will be able to vaccinate about 5 billion people this year. And of course, that's not very easy. And so the Economic Intelligence Unit already tells us that we are going to face a significant challenge based on income. Not just you have money, but also do we have the supply? And so those who first made the reservation and paid are able to get it as soon as possible. So in this race, probably, according to the EIU, the Philippines will get the full vaccination by 2023, right? So to me, it's important that we start in 2021, and other countries will also will need to take time for everybody to get vaccinated. So if you are looking at this perspective, probably 2 to 3 years for the world to be completely vaccinated. And so with that, how do we move forward, we now need to look at the internal capacities of our economy because these things are beyond our control. We do not control the performance, economic performance of other countries, which is 40% of our economy, and we do not control the availability of the vaccine, right? So what is it that we control? Now, let's look at what we control. What we control basically is the domestic economy. And you can see in this chart that you are seeing right now that there is a V-shaped recovery that we are experiencing. V-shaped meaning the economy is trying to get up as soon as possible, but still very deep down negative territory. And so that is our situation at the moment. And if you look at the performance of our manufacturing last year, it was really a very challenging year for our economy. Many of our industries, except only for pharmaceuticals, really have difficult time. And so this is also shown in their inability to really have confidence to borrow. As you can see, the borrowing of banks have gone flat. That of firms to banks have become flat. That means almost the same only as last year. So if an economy is growing, there would be a bigger borrowing in terms of percentage this year. But that is not what we are seeing because banks also are having challenges lending because there are borrowers who are not able to pay. So the non-performing loans of banks are also increasing. So because of that, they are not able to lend as much as they want because they want to make sure that those that have borrowed from them will be able to pay at present and not to increase furthermore the borrowings that are not going to be paid in the future. And if we look at the look moving forward, is that going to be the case? We are looking at the manufacturing index. As you can see, the manufacturing sector is already somehow not really recovering, but the decline has plateaued. That is a sign that the worst is over in terms of manufacturing. So there is now an opportunity for a little bit of push so that the manufacturing sector will get back its bearings. So as you can see, there is already signs of growth that is showing in the manufacturing sector. Now, that is on the firm side. What about the consumer side? The consumer side is something that we want to address as well. The consumer side, we have a problem basically of people not having jobs, right? And this is a reality caused by COVID because not everybody can work from home. So those who have lost their jobs, some of them tried to find jobs but are unable to find it because the system and the way of doing things have changed. So they need to skill up or increase investments in connectivity, which is not cheap and it's also requiring significant learning of time. So there is a learning curve as well. So because of this, we see many people very careful in their expenditures, right? Because last year only the agricultural sector created jobs, all the rest lost jobs, and the Philippines actually posted the worst job losses in Southeast Asia. And so because of this, the behavior of the Philippine workers is really not to consume so much, but really to hold on to what they have. So they started to like just focus on the essentials. So focusing and giving priority only to the essentials, which is basically communications, internet, utilities, water, power, and then food, right? And a little bit of miscellaneous expense, meaning adjustments to work from home. But the rest, really, comparing to previous years, this is so different. You have pushed people to the essentials. So what are the chances that we move out of this mindset? Because if we will be remaining consuming only essentials, will be a big challenge for us. And so this is where the government comes into the picture because we need the help of somebody. Somebody has to push the private sector, the firms and the consumers. You need to expand, you need to consume, you need to produce. Otherwise, the economy is going to be very weak. And this is why the government has to borrow money. And they have been borrowing. In fact, it is not necessarily bad for government to borrow as long as what you have been borrowing, you are able to pay. or you have the capacity to pay. So just like in firms, you have seen the Philippine economy, it has been increasing in its borrowing because the economy has been growing, the asset base is growing. So in a company that is borrowing or using leveraging, because they know that their asset is growing, so they can actually repay the debt anytime if needed, so they can be converted to liquidity. In the case of the economy, it's the same. However, in this pandemic, the government has Philippines still, however, is way below the borrowing ratio of Japan and Singapore. For example, Japan, more than 200% of the GDP is their debt, and Singapore is more than 100%. The Philippines is about 40 to 50%, which is not necessarily good, but not necessarily bad compared to these other countries. Meaning, in fact, if you look at it from the perspective of a creditor, this is still there's still room for a little bit of borrowing because if the asset base goes back, then it can be paid in the future, right? So that's the thing. However, the government has been borrowing mostly domestic compared to the perception that it is international. The borrowing to me is not the challenge of our governance in this pandemic. It is more the use of the money because since many of the private sector are not really moving, they are stunted by the economic slowdown. It is the government only that has the money to spend, but it's not spending much and able to spend enough. And this has led to the build slowing down, as you can see in this chart, right? It has to be spending, but they have the resources, but they don't have the capacity, absorptive capacity to use the resources that they have. And so we also look at the how the people are using now these resources that they have, right? Because the government did not only try to solve it by using build or infra. They also provided loans. They also provided bayanihan funds to support the economy. And so, since many people still have work, no, it's not that a lot of people really lost jobs. Yes, indeed, but there are people who still have jobs, and these are the people who have quality jobs that they are safe and they're able to convert their economic activities online. And in fact, earning continues to earn or earning more in this pandemic. And so these are the A to the B classes of our society. These are the people who are increasing actually their savings. No, their savings has increased in this pandemic, and because their savings has increased, what did they do with this money? Because they cannot travel, they cannot buy new things, they are not getting out to eat every week. So you have an opportunity for income to increase and savings to increase. And since this is unexpected increases in savings, where did it go? Some of it went to the increases in the stock market. No, the stock market was down to 4,000, recovered. Now hovering about 7,000, 6,000, 7,000. So almost a full recovery, right? But the valuation are not necessarily good, but still there are stocks to buy, so people are able to use some of their income going there, some of their savings. The others put it in IPOs, whether in stocks, in bonds, and the government bonds. They are all oversubscribed, and some of them put it in buying housing, real estate, condominiums. Right in the second quarter of last year, when the economy nosedived, the prices of real estate actually went up because people thought that the economy is going down, so prices will go down. So all those who have money spent it buying condominium and real estate. But no, in a pandemic, in a recession, the real estate does not recover that quickly. Okay? So it's good to invest if you have time to wait, but note that the recovery is not going to be that fast, right? As you can see, the real estate sector really went down as well, and it's just recovering, still negative, right? Still in negative territory. So you still have to see economic activity for the real estate sector to be sustainable, right? Of course, there will always be need for real estate, but the the returns, when are they coming back? That's another question, because you need to see economic activity conversion first before people go back investing and buying homes and other commercial or industrial related stocks and requirements for their investments in real estate. One of the biggest challenge we are facing right now is inflation, right? And we forecast that this year would be high inflation compared to previous years. Not high in the highs. No, the Philippines had double-digit inflation in the past, but most of you who are probably watching this now have not experienced double-digit inflation. So that's not going to come back. But high in your perspective, in your standards, because it will be more than the benchmark 2 to 4%. Because not is it because BSP is not doing monetary policy well? No, it is because of supply choke, meaning there's not enough food going into the markets. We have supply chokes, and that is something we need to address very soon. Cannot allow it to continue because it will affect the economic performance of the recovery. Because if things will be expensive, have enough resources, they will be forced to buy their essentials at a high price. So it has to be addressed soon. So we believe by summer there will be a better supply of food products, particularly pork, chicken, and the rest. And by that time, the economic challenge of inflation would be subdued. But of course, because you have hit high uh, in a month in the last 6 months, then the base effect would only come in the second quarter. Second half of the year, right? And this inflation is also caused by transport increases and food price increases. Transport, because people are unable to do public transport, so they ride tricycles, which is very more expensive, and 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 for the ordinary people, this affects their budget a lot, right? What one good thing about all of this is, because since there is very little economic activity in other parts of the economy, particularly the big infra, it has caused the smaller infra to move very quickly. So, for example, house building, repairs, and the likes, you are seeing lower construction material costs. So this is a sign that you go first to the repairs, no, and to the small expenditures of construction. So there's an opportunity there. Now, in regard to exchange rate, using theory, we see that exchange rate will at most go back to 49, but it will hover around the current rates. Why? Because our economic activity, as I said, 40% international trade. And that means if we are not importing so much, then that will affect our overall value of our exchange rate, because exchange rate is the price of our international trade. So if we're not buying imported products, which we notice is happening because of our less economic activity, then the demand for dollars are not as much as before. So that forces the peso to appreciate against the major currency, the US. And that also allowed us to pile up our economic reserves, international reserves, right? Um, Also, it's not only that because there are less imports, there are also other sources of foreign exchange coming in, like foreign investments. Silently, there are still foreign investment, though not as high as Thailand and Singapore and Vietnam. Um, of course, the most surprising source of foreign exchange that has increased the peso, is the OFW remittances. And you can see in this chart, we expected it decline, but it increased. With the BSP already reported, it in fact increased or almost, it decreased only at a very minimal rate, almost plateauing, right? Do we expect this to continue? Most likely, it will be like the trend is like this. because most people who had lost their jobs last year have not been able to get new jobs, and there have been less people sent abroad. So in that case, those who are left will be need to send more money to be able to cover that, if that is the case, right? So we cannot depend so much on OFWs as it was before. Not until more people are allowed to go and live and work abroad, and if there are job opportunities open for them. But one thing silently that we did not notice help the economy also generate foreign exchange is the BPO sector. The BPOs, actually, you can see here, they were growing despite the pandemic. Yes, because the pandemic, these are the sectors, the BPO sectors have been prepared. They have been online for the longest time. And so they're easily converted and they easily continue their activities despite the pandemic. So they did not hire more people, but their volumes and valuation of their outputs have increased, right? Tourism, of course, took a big hit international, but domestic, not necessarily. We lost about 80% of revenues and tourists last year, but domestic tourism is still an opportunity that we can take advantage moving forward. And of course, agriculture. They created a lot of work last year, but most of these are basic work. So we need to upgrade agriculture to interconnect it with digitalization, allow people to work and connect to the logistics side, to the market economy, using digital technology. The supply problems we are experiencing right now because many of our farmers, livestock raisers, fisher folks, they are still using very traditional way of doing things. But if we upgrade them to the last mile logistics, then we have the opportunity to improve and take advantage of the opportunities of agriculture. And as I was saying earlier, the reason for high prices in inflation is also transport. And so government knows that. So we should be seeing more opportunities in improvement in transportation. So the World Bank tells us that you can recover as long as these three things are addressed. Firstly, is we need to continue to have public health intervention, meaning even if the vaccine comes, we cannot stop the protocols, wear mask, face shield, social distancing. This should continue, and in fact, to me, should be very strict so that we can finally hold the impact of the vaccine, right? And remember, other countries are also experiencing negative shocks. No? So not all countries are recovering as fast as the others. So and then the virus creates second, third waves. So other countries are having that as well. So it's also important where is our economy dependent upon, and mostly in the Philippines, OFWs. But the other countries, they're dependent on tourism and on FDI and the likes. Okay. What is the preferred recovery? Now, I want to distinguish between the recovery called the shapes, which is talking about growth, and the other one is called the levels. So if we're talking about the growth, then it could be a shape of L, W, U, whatever, right? And we are showing you in this table, in this chart, which are the sectors that will be affected by this growth. And as you can see, the growth of them will be affected differently because they're responding differently to the crisis, right? So it will be dependent on the sector. And if you look at all the sectors, some sectors will grow faster, some will not. And that is what we call the K-shape. I'll explain that later. Now, and look at this chart, you will see a V and a swoosh. The V represents the growth, right? So there can be a V shape for the recovery, but for the levels, you will only get like a Nike check, a swoosh, right? Because you're growing but not at the same path. That is the meaning of the swoosh level. And K is where some sectors will grow faster and better, and the others will really be pulled down, such as what we are seeing in accommodations, in tourism, airlines, are really pulled down. but you are seeing improvements in BPOs, in tech-related industries, and even those industries that are not tech-related but they have converted technology, they will benefit, like being able to sell online, doing good e-commerce activities, right? And because of this, we are looking at a very subdued recovery for the Philippines in 2021. Now, I'm showing you forecast based on the assumption that if we continue to be doing the same things like we're doing today, not much change, right? You see, the virus, we are living with it, but we are not beating it yet. So in that context, the best we can grow is only 3%. Right? That means there's no significant government intervention. There's no significant change in business investments, and consumers continue to consume at the current levels. Then we can only grow at best 3%. Right? But we will be getting out of the recession by the second quarter, mainly because of base effects. Too low performance last year, so we can get up, but not to the extent that we will recover at growing at 8%. That's not possible until you have really great big economic stimulus, combining stimulus and economic confidence by firms and consumers. And so, at the rate we are growing, we can only get return and get back the 2019 economic performance and levels in 3 years, which is a long time. But I think the rest of the world will also will go through the same process, right? And some companies are actually asking the government to do more, not just give us money, but also improve your economic digitalization, because that can facilitate economic activity. And true enough, we need to do and work for that. That will facilitate recovery. Digitalization is one of the most important push that COVID created, and we should all be going there and improving there, especially now that the third telco is coming on board. Now, the Philippines continue to be 37% cash-oriented economy. We are so far away now from Indonesia and Vietnam. And even in the distribution of the stimulus, it took us almost 6 months to distribute that money, because we don't have a very good digitalization of the payment structure in our economy. So these are opportunities. I'm showing this to you to show you opportunities, not threats, but opportunities can be converted to economic activities soon. Now, having said all of that, we still need to continue, as I said, to invest in improving our protocols and unifying them and make them consistent and easy to understand, right? Because you see, this is I'm showing you a comparison of sort of good news, because the Christmas season was expected to increase the cases, but that did not happen in Metro Manila. In fact, it has remained flat. There's a little bit of an increase, but not to the point that the hospitals were overwhelmed. So that means we are able to manage this COVID. We are able to minimize its impact, but we are still not able to overcome it. No, because the Google report, in fact, showed increase of economic activity in December, but it went back again to low levels in January. So that means we can be confident enough and be careful, but we need to do something more, right? What is that more? We need to lower the number of cases. No, because with that, I think even without the vaccine, if we are confident and good enough, we can bring back the economy. The consumer are very important. This last slide I'm showing you, the importance of the kick of the consumers. They kick up economic activity in the fourth quarter of last year. Government can only do so much. They are very little compared to the size of the whole economy. 70% is consumer oriented. Only about 10% maximum is government. So the consumers need to get back on track in their economic activity, right? So in summary, I've said already, the world needs to recover, because 40% of our recovery of our economy is connected to the world. Confidence can go back, when the vaccine is start to roll out, and also when we see consistency in the falling of daily number of cases. That could really like boost the confidence of people to go out. And there is an opportunity. This might be last call for low interest rate environment, because if inflation is not managed well, and then if it goes pushing interest rates up, that would be a challenge, right? So we need to be worried about inflation. These are the challenges we are facing moving forward in this pandemic. Other than that, if there is significant change in government stimulus in the response of consumers and producers, we will grow faster than 3%, right? And that I cannot say, but I believe it can go back to 5, but not necessarily 8. It can outgrow 3% this year and moving forward in the coming years. So with that, I'd like to thank all of you. Please do not wait for things to get better. That's the advice of the Bible. Do not wait for things to get better. Just do what you are doing best. Continue to do it, and do not wait for things to get better before you do something. So thank you very much, and I hope you learned from this sharing, and looking forward to getting questions from you. God bless.
There you go. Thank you, Dr. Ang. That was such an insightful discussion. So many takeaways here, but I feel that, compared to a lot of other reports that we've seen on the economy, yours has been very realistic, also very, very specific. And I just want to highlight a few things that you mentioned, particularly the bright spots here, because you really highlighted the fact that, recovery will be slow, but it's at least already underway. So maybe 3 years until we get pre-pandemic levels, but the worst case, or at least base case, it will be 3% growth. You did mention, smaller infrastructure projects are ongoing, remittances surprising on the upside, BPOs are remaining resilient, worst being over for the manufacturing sector, and still some space there when it comes to the debt to GDP ratio. So actually, we can still tap on some resources there. Quality jobs have been saved, and we do have increased savings for the A and B classes. And I think, that's very much related to why we're even holding this discussion today, because it's not a state of, panic or poverty, but in fact, it's a state of being able to invest for the people who do have it. I also heard in one session that I had, the wheels need to keep turning. It doesn't matter where it comes from, but any wheel that turns will bring, a bigger wheel to turn in the economy. So thank you so much for all of those insights. We will need to be digesting that, and of course, we will be asking you quite a lot of questions later on, Professor. Okay, guys, how is everyone doing so far? I'm sure there's a lot of questions, so please, I'm sure we've seen some questions already, but for those who still have some questions, feel free to type them into the chat box. We have specific chat moderators who will be answering your questions, and then we will be throwing them to the speakers later on. So before we proceed to our next speaker, let's all have another game. So here is the question, okay? What is the fourth quarter 2020 quarter-on-quarter GDP growth rate of the Philippines? If it did grow, or if it did not, then what would be the contraction rate? Again, fourth quarter 2020, last year, quarter-on-quarter growth or contraction rate. Is it A, -2%, B, 3.9%, C, 5.6%, or D, -5.6%. I recall that this is compared to the third quarter. So select your answer now. Make sure you chose the right answer. We will have 3 questions like this throughout the session. And those who get at least 2 questions correctly will get a chance to win our grand prize. So the grand prize, very, very interesting. We'll have more information on the specific product later on, but just as a teaser, it's FMETF investment credits worth 5,000 pesos each. So you get 5,000 pesos automatically to invest. I think that's a very, very interesting thing. So you don't have to even think about it. It's going to be there for you, and you just have to answer 2 out of 3 questions that you should already know the answer to anyway. So we won't tell you the correct answer right now. I think I know the answer, but I'm not sure if we're allowed to say it. So stay tuned until the end to see if you are one of the lucky winners. Now, before I proceed, I'd just like to thank our fund partners for co-sponsoring this briefing. So this event is brought to you by First Metro Asset Management, BPI Investment Management, Sun Life Asset Management Company, ATR Asset Management or ATRAM, and Phil Equity Management. So you guys can subscribe to these mutual funds through fundsmart.in. This is your first Metro FundSmart, okay? That is in your first MetroSec account with absolutely zero sales load. So once again, thank you so much, sponsors. This is, of course, an event that is very useful and only possible because of you guys. Now, okay, moving on to our next speaker, Royce Christopher A. Aguilar. He's currently an equity research analyst of FirstMetroSec. He heads the Retail Research Division and is specifically in charge of the creation and the maintenance of the daily and weekly reports that you guys receive and see in your website here, but also I get it via email. So thank you, Royce. Royce is also the co-creator of FirstMetroSec's Traders Playbook. This is a company report that incorporates both fundamental and technical analyses. So Royce, the floor is yours.
Okay. So welcome to our 2021 Traders Playbook event. I'm Royce Aguilar, part of the Equity Research Department and in charge of the Retail Research Division. So I'm here to present to you our strategy, outlook, and of course, the favorite segment of almost everybody, our topics for this year. But, before we present our topics, we will tell you our outlook for this year and how we came up with our assumptions given our data-driven approach. So, our year-end target for the PSEI is 8.4 to 8.6, and we are one of the more bullish firms for this year. And it's because we think we are still in the early stages of the bull market. As seen in this slide, bull markets that are born from recession or economic slowdown typically last for years, not just months nor quarters. And I think we can all agree that since restrictions are just easing, the economy is primed to rebound stronger. Moving into this slide, we think that the next phase of the reflation in the country now hinges on two things, right? First is investors fully subscribing to the V-shaped economic recovery. So, the fact is, some are still fearful to invest or to accumulate further in this market. Some are thinking the economy is still fragile. Some are thinking that the market may have already priced in the recovery. But for us, it's just getting started. That brings us to our next point, that multiples can remain elevated, supported by the large buffer in the equity market's risk premium. Okay? So the next point now is earnings should catch up in valuations, because some are thinking that maybe the market was already priced in the recovery. Imagine we went as low as 4,000, we're now at 7,000, right? Maybe the market has priced that in already. But for us, the earnings will catch up this year and next year. So it's driven by our outlook in V-shaped economic recovery, pent-up demand, and positive operating financial leverage. So we will tackle that further later on. The next point is foreign fund inflows. So you'll see there in the chart that it's at historical lows. So for us, moving forward, should there be catalysts like successful vaccine rollout, as mentioned, for the reopening of the economy, that should bring foreigners back further into the country, right, into the PSEI. So bottom line, you still have more upside ahead, given these reasons. So as mentioned earlier, investors are not yet fully subscribing to the V-shaped economic recovery, right, because of the fear of the once unknown. But what we believe is that the nature of this crisis is transitory, meaning short-term, not permanent. So it's no secret that we believe in the V-shaped economic recovery. So the good thing though is economic data are already improving or showing signs after a couple of slides. So it's also worth noting that the size of monetary and fiscal packages have cushioned economic fallout and have actually provided a boost in the recovery in the economy for the second half of the year. So you'll see here in the slide, the COVID-19 pandemic rescue packages have really been ramped up compared to the previous crisis that we faced. So on one hand, the BSP was quick to ease monetary policy and augment system liquidity, right? And then on the fiscal side, we had the Biennium 1, Biennium 2 stimulus, and right now we are seeing a possible Biennium 3 worth 420 billion, right? So looking back at the Biennium 1 and 2, we saw loan payment moratorium, rent reprieves, extended deadline for income tax payment. So those things kept businesses, kept consumers liquid, and afforded them this flexibility to navigate through this crisis. So here in this slide, you'll see now the data that we're talking about, right? So we see here the GDP growth, retail sales growth, manufacturing PMI, industrial production index. It's well off its lows, right? Of course, it's not yet pre-COVID levels, for example, for GDP. But one indicator here that we'd like to highlight is the PMI. If you search the definition, PMI is actually one of the most reliable leading indicator for assessing of the state of the economy. And keep in mind that PMI for the Philippines is now at 25-month high. So this gives us confidence that economics should rebound stronger in the coming quarters, definitely. Especially, it's also hinged on the further reopening of the economy also. But for us, some sectors are already showing signs. Right? So retail sales growth, you will see there, it's just down by single digit. Okay, so it's getting there, and that should, those data should support a further rebound in GDP moving forward. So next is, another point that we have is the country's economic drivers are in a good position coming out of the crisis. So usually when you come out of a recession, you check the health of the economy. You check if the drivers of income and the extent of the damage is so significant, right? And you check how fast you will recover, given checking the extent of the damage, the drivers of income, and the like. So for us, we like to check three things: the household, business, and government finances. In this slide, we highlight that during the pandemic, households were able to deleverage and at the same time grow their savings, right? You will see that also in the next slide, but specifically on this slide, you'll see the data below, the quick rebound in labor market, right? So you'll see it's not yet at pre-COVID levels, but it's well off its lows. And again, moving forward, should more companies rehire, bring back their employees, further reopen, the data should improve. So yeah, here in this slide, you see remittances just down by 0.8% year to date. And that is actually a surprise for all economists, even the BSP. Governor Jokno said that this is far better than the central bank's initial forecast of a 2% decline. Right? Some were actually even predicting a slump of 10%. So this data came as a surprise for everyone. Right? Okay, so on this slide, we will see how healthier corporate balance sheets are. So last year, we know that there was a significant cut in spending, which actually provided rooms for these companies to pare down debts. So the low interest rate environment enabled them to refinance borrowings at lower interest rates. We note that the aggregate net debt levels of the largest Philippine corporates improved by 9% in the last 2 quarters. So on the next slide, this is actually another leading indicator that we would like to highlight. As of the latest Ph.D. surveys, households and corporates' outlook for the next 12 months improved in view of adapting to a new normal, anticipated availability of the vaccine, more relaxed quarantine measures, higher sales for corporates, and more jobs and income for households. So this is good to highlight in support of in our expectation of when the some households are given the opportunity to spend, they have enough capacity to do so. Again, in this slide, of course, this is the time we talk about some other people's view that the country has huge debt. Can we further borrow? Of course, we acknowledge that the government's debt ratios have risen to levels that were last seen during the global financial crisis. But we think the government can still afford an elevated but manageable deficit spending program. But we have a couple of points to support that. First one is credit ratings are at historical highs. So that should allow for cheaper incremental debt at very low rates and longer repayment periods. Okay. Another is growth tailwinds from catch-up spending on high multiplier infrastructure projects. So those things should keep debt ratios manageable. Okay. So now, moving forward, um, again, we think the company, or rather, we think, the country, even the PSEI, has more upside ahead in terms of growth, in terms of increase in asset prices, mainly because we still have a lot of room to do so. You'll see here, air traffic flight count, air traffic passenger count. Okay, it's well off its lows, but if you take a look at the chart, it's still significantly lower than pre-COVID levels. So that should tell us, okay, we are seeing consumer confidence rebound a bit. Should vaccine rollout be successful, that should really result to pent-up demand, right? More people really going out. It's just a matter of more confidence hinged on the successful vaccine rollout, right? It's just a matter of putting completing the puzzle, right? But it's getting there. That's our point. So, given the chart that you see below and the chart you see here, we are of the view that the Philippines should benefit the most from vaccine availability, mainly because we have that, room ahead to grow, right? Take a look at the Google Mobility Report. It's well off its lows, but it's not at pre-COVID levels yet. Quarterly beer volumes, which is of course hinged on tourism, less tourism, less tourist spots open, less beer consumption, right? Again, well off its lows, improved already, but the upside is still there, right? So where are we on the vaccine? On Feb 23, I believe 600,000 doses will arrive from Sinovac vaccine. And we also recognize the significant efforts of our local government units, right? You see there, the local government units have made agreements with AstraZeneca and national government for around nearly 20 million vaccine doses. That's a welcome development, and that's where we are right now. And that's, it should improve ahead, right? So moving into the earnings specifics. So for us, V-shaped recovery is the right narrative at the moment. High frequency data in the past few months indicate increasing economic momentum despite ongoing restrictions, right? And we argue that the recovery will be sustainable and can even shift to higher gear. So again, we mentioned pent-up demand. So of course, it's just a matter of can we spend further, right? And yes, we can. Supported by healthier household balance sheet, right? You saw quick improvement in jobs data. You saw remittances being resilient. And then, in terms of margins, we are seeing companies have positive operating and financial leverage, right? Okay, and lastly, earnings risk are still tilted on the upside. Okay, so first of all, earnings can quickly rebound on low base effects from last year. But we also have another catalyst, right? And that is the passage of the CREATE bill. Keep in mind, large corporates from 30% income tax rate will be lowered to 25%. And then for smaller businesses, for small to medium corporates, to 20% tax only, right? So you have upside ahead, which can be a catalyst for significant earnings growth in the next 12 to 24 months. Okay, so of course, equities is one of the more riskier assets, right? So what can derail our V-shaped economic recovery? Number one, inflation. Should inflation surprise on the upside? So of course, there's potential for acute price spikes that could come from stronger demand, running ahead of tight food and inventory supplies, right? Another point is a significant rise in yields. So of course, higher than expected inflation rates could lead to a faster rise in yields. So those two things come hand in hand. What concerns us is, of course, should inflation, especially the food and segment, should continue to rise in the coming months. That should be a concern now. Okay, but for now, we prefer to look at more data ahead. Another is lower than expected rollout of vaccine. Keep in mind that some vaccines have storage requirements, temperature requirements, right? And should it not be met, the efficacy rate could be lower, right? Another thing is, should outbreak returns in waves with new variants that could lead to further uncertainty and the market does not like uncertainty, right? Next is the slower than expected easing of business restrictions. So that is also a risk, especially if we see local government units persist for the age restrictions to maintain. That should be a bit of a risk. Another is emerging market and Philippine economic recovery did not materialize. So, of course, um, besides our country recovering, we should see other emerging markets also improve, because keep in mind that some fund managers invest in emerging markets, and we are one of them, right? So we also benefit from the improving macroeconomic prospects of other emerging markets. Last is stronger US dollar that should mitigate fund flows into emerging market equities. Historically, we actually observed that the emerging market currency basket has a high correlation, specifically above 80%. So on the foreign fund flows into the Philippine equities market. So now, moving on to our stock picks. So, of course, before anything, we like to present our outlook for property, because that's our property is one of our top sector picks. So to be specific, on the residential side, we expect the segment to recover well. And that demand is actually healthy given the imbalance between pre-sales and launches. So if you take a look at the first 9-month figures of each companies in our coverage, there is inventory drawdown, meaning higher pre-sales than launches, right? This tells us there is healthy underlying demand, and that lower pre-sales were in part affected by lower launches by property developers. Hence, with more construction, selling activities, this year, the first order of priority for property developers is that they should address tight inventory levels, thus supporting pre-sales. For the office segment, we expect that to be stable. And of course, given the market volatility, stability is what we want, and stability is what we expect for the office segment. We just like to specify that BPO demand should offset the unwinding of POGO exposures of some developers. So for malls, so we cannot reiterate enough that the key is reopening. So we saw mobility reports relating to retail and leisure activities have been increasing, meaning that some Filipinos are now willing to go out, right? And with more entertainment activities available in malls, it will boost mall foot traffic. And right now we are seeing that there is more headroom for that. And then for hotels, I think the thing here is it's more cost efficient now to do webinars like this, to do events like this. So it should take a bit longer to recover on the hotel front, on the hotel segment. Okay. So moving on to our picks. So first one is we have Ayala Land. Our target price for Ayala Land is 52 pesos. So more than 60% of its EBIT, so that's earnings before interest and taxes, comes from their bread and butter, the residential segment. So they can very much leverage on the pre-sales development, especially since last 9 months of the year, 8 billion on launches, but pre-sales were 60 billion. So addressing inventory level should be the story for Ali this year. So next is SM Prime Holdings. Our current target price for that is 45 pesos. So of course, it is the biggest mall operator, so it's definitely a reopening play for us. Another thing is we estimate reservation sales to pick up stronger this year, 20% specifically. Of course, as we've mentioned on the economic segment of this presentation, we are seeing remittances, low interest rate environment, and better consumer confidence ahead. Next is Robinsons Land Corporation. So this is actually quite unique, mainly because we expect REC's earnings this year to already exceed 2019 levels. We are positive on the timely recognition on the Chengdu project and other joint ventures in order for the company to bring back its performance already to pre-COVID level this year. Okay. So next, consumer. So we have to clarify, we are neutral on the consumer sector as a whole. but we are positive or we are bullish on the consumer discretionary businesses, the likes of or the picks that we'll mention in the next slide. Will be a shift to discretionary spending. We are more positive based on household fundamentals and believe there will be support to pent-up demand. So, of course, survey results are actually showing that business, that Filipino consumers are among the most optimistic last quarter, right? So that should, support earnings recovery for the consumer discretionary spending moving forward. And on the margins, on the margin front, some names have taken cost efficiency measures with lower cost base and higher operating leverage already. So margins are set to expand for these companies, and the first one we have is San Miguel Food and Beverage. So the current target price for that one is 81 pesos. We're bullish on beer volumes. That's the bottom line. It's yet to revert to pre-COVID levels, but the volume recovery in third quarter showed that there is demand. Just 6 million cases short of pre-COVID levels, despite limited nightlife and tourism, right? So, of course, additional catalysts is the food segment on firmer selling prices, sustained market share gains in the spirit segment, and lower corporate income tax rate, which we are now, which the government is really focusing on. Another consumer discretionary pick of ours is Robinson's Retail. So grocery is a sizable part, but with mall traffic improving, we should see improvement in its retail and discretionary formats. When restrictions ease and individuals start going to work, they may want to replenish their clothing. Also, once age restrictions are widened, foot traffic and malls will improve on the back of family trips, consumption. Also, when kids are allowed, they can go to the specialty stores, the Toys R Us, right? The pet stores that RHI owns. So there. Our target price is 88 pesos. So we're also positive on the financial sector, okay? So for loans, system-wide loans growth, because banks were conservative, right? So now we think that the shift of loans to pre-pandemic years will be contingent on two things: GDP growth and successful rollout of vaccine. And we cannot stress enough that vaccine is a panacea for Philippine banks. It's a solution for all the difficulties for banks, right? Not only will it allow for greater reopening of the economy, it will also boost credit demand or the confidence among businesses to take loans and expand and households to spend, thus encouraging banks to lend out. For policy rates, given inflation surprise, we are of the view that PSB would take a pause in rate cuts. On the net interest margins, so that's the NIMs, we expect that to hold up in the next 12 to 24 months. So the lagged effects of the easing cycle should mitigate pressure to net interest margins. For loan loss charges, we are of the view that NPL, so that's non-performing loans, will have limited upside this year, resulting from the positive impact of the Bayanihan 1 and 2 on borrowers' liquidity management. So let's move on to our picks. So it's just keep in mind we cannot recommend Metrobank mainly because we're on the same group. But just like to be clear, we're positive on the financial sector. Okay. So first pick is a BDO. Our current target price for BDO is 150 pesos. So the cyclical improvements in the economy and search for yield, as mentioned in this slide, by foreign and local funds amid the low interest rate environment should benefit BDO. Especially it's an index grammar names, one of your index heavyweights. And we see legroom for the for BDO on the back of, again, for the reopening of the economy, right? To be specific, we expect gross loans to grow by 8 and 10% in 2021 and 2022. Another bank pick of ours is BPI. So we have a current target price of 99 pesos. So we like BPI also for its exposure to the real estate sector. So that segment comprised roughly a quarter of its total loan book based from the 2019 financials, right? Of course, as mentioned earlier, loans given healthy underlying demand and expectations of recovery in supply. And then, management is also more bullish. They have improved outlook on non-performing loans. They have healthy mortgage credit demand, increase in auto loans, among others, right? And then also they have this merger with its subsidiary BPI Family Savings Bank. So that should allow for branch rationalization and elimination of redundancies within its network. So of course, we are positive on property, retail, and banking sector. So that it makes sense for us that our top pick amongst all our picks is SM, and we have a current target price of 1,250 for that one. So of course, we understand that valuations have run ahead, but on a recovery market, it is unlikely to see valuations trading at around 1-2 standard deviations. So as of last check, we haven't seen it with SM just yet. So bottom line, we see upside for SM despite already trading at one from as low as 500, if I'm not mistaken. Okay. So here in our last slide, you will see here a summary of our picks. You'll see here the current price, the target price, and the upside as of last Friday. So these are our picks in pecking order, meaning in terms of priority. So first SM, and then the property names, and then the consumer discretionary names, and lastly the financial names. So thank you, and I hope this presentation helped you in your investment decision making this year. So thank you.
Issues there. Okay, I hope everyone took note of First Metro's stock picks for 2021. So as mentioned by Royce, there's quite some room to go still. The valuations can still remain elevated this year. The earnings are yet to catch up. And he did mention some leading indicators here that are optimistic, and that is leading to these stock picks. So he mentioned that there's still some room to go when it comes to consumption and foot traffic in areas and in malls. So guys, you know what time it is? It's time for another pop quiz and another raffle. So let's start with the pop quiz, which should be popping up on your screen in a few seconds. If you were listening, what is the year-end PSEI target of FirstMetroSec? So again, the year-end target price for the index, and choose the letter of the correct answer. Letter A, 7,900 to 8,100. Okay, letter B, 8,100 to 8,300. Letter C, 8,400 to 8,600. And letter D, 8,800 to 9,000. Okay, so depending on how bullish you are, you will choose the answer. But again, how bullish is First Metro Securities? So again, we will give you a few minutes or seconds, let's say, to choose your answer. Again, if you choose 2 answers correctly, you automatically qualify to win 5,000 pesos worth of FMETF certificate. Note, guys, that if you want to claim this prize, you will first need, of course, a FirstMetroSec account. And if you don't have a FirstMetroSec account, I think that's the reason why you're also attending this webinar. You can open one very quickly online. So you visit www.firstmetrosec.com.ph, and then you click Open an Account. If you are not a Metro Bank depositor, you can still proceed with that application. So you just open a digital deposit account via the Earnest app. But make sure, guys, to input TP 2021 when you are asked on how did you learn about us field. So this is available only Mondays to Fridays from 12 midnight to 2 p.m. only. Okay, so you have a few seconds left to answer. All right. Recall that I was checking on your answers earlier onto the GDP question. The answer was, of course, 5.6% growth from fourth quarter compared to third quarter. Not a lot of you got it, so I hope this one is correct. So, okay, we will announce the winners at the end of the program. All right, guys, let's move on to another quick raffle. That will be popping up in your screens in a few seconds. Again, if you want to join, all you have to do is click the join button, and you will get a chance to win another batch of 500 pesos worth of 7-Eleven e-gift certificates. Okay, there you go. So start clicking. And while you are doing that, let's pause for a while and learn more about this organization, of course, behind this very nice event that is FirstMetroSec. This is the online stock brokerage house of the Metro Bank Group. So it has a web-based trading platform and a mobile app. You can now invest in stocks, mutual funds, bonds, and a lot more. So take a look at this short video.
Why look elsewhere when you can have investment and trading options all in one place. Available when you need it, on the go. Peso and dollar denominated stocks and investment funds. Margin trading. Automated chart pattern recognition tools and research reports at your fingertips. Do it your way. Go classic or up your game using Pro. Always on the go? Easily switch to the mobile app with FirstMetroSec. You can create a multi-asset, multi-currency investment portfolio that goes wherever you are. Not yet ready for stocks or just looking to diversify? Have the flexibility to invest in funds only through FundSmart, your one-stop shop for the leading managed funds in the Philippines with no sales load. Actively trade at your own pace or build your wealth through cost averaging. Commit your regular investment, indicate how much, and let it grow over time. Funding your account is as equally easy through online bills payment of Metrobank, PS Bank, and our other online banking partners, or through your credit card. If you're into technical analysis, take advantage of Recognia's automated chart pattern recognition, which identifies buy-sell signals and support resistance levels. Sharpen your skills with online instructional videos and quizzes. You'd be better equipped to plan your trades for potentially greater profits. Don't know what to buy or sell and when? Read up on daily research reports, market updates, outlook, trading ideas, and technical analysis expertly presented by industry analysts. All for free with your FirstMetroSec account. Catch regular webinars and Facebook Live sessions, or join the growing community of the official FirstMetroSec Facebook group, whenever, wherever you may be. All the options and convenience within your reach through Finance Asia's back-to-back best broker and International Finance's best online broker and best online trading platform. With FirstMetroSec, you only need one.
Okay, guys, you have a few seconds left to enter that raffle, and in just a few seconds, we will be flashing the names of the 5 lucky winners to receive the 7-Eleven EGCs worth 500 pesos. So I think you can see that on your screens right now. Congratulations, everybody, and thank you so much for joining. FirstMetroSec will be in touch with you after this program. All right, guys, let's move on to our last speaker for this afternoon, Mr. Aaron Sai. Mr. Sai is a consultant at FirstMetroSec and an investment strategist and portfolio consultant at Rhyme and Reason Investment Research and Management. He is a former economist at the Bangko Sentral ng Pilipinas, a former research analyst at FirstMetroSec, and a former auditor at SMART, a chartered financial analyst candidate, and a chartered market technician. He holds a bachelor's degree in Applied Economics and BS in Accountancy from the De La Salle University of Manila. With the topic, Will History Repeat Itself? Please give a round of virtual applause for Mr. Aaron Sai.
Thank you, Danny. Really a privilege to have you as our host for this year's Traders Playbook. Well, good afternoon, everybody. Bago pong lahat, I would like to thank you for spending your Sunday afternoon with us and congratulate you as well for finding time to learn about the market and, of course, the opportunities and definitely the risks that might be in store for us in the coming months. So my part for this afternoon is entitled, Will History Repeat Itself? Well, for those who attended the monthly wrap-up of First Metro Securities in December 2020, you sure know that indeed history repeats itself. Well, because practically I am repeating it now for the same purpose of guiding us, traders and investors, about what a study of the past has shown us and how we can use what we have learned to equip ourselves in facing the market. So yes, the question, does history really repeat itself? Or if it does, will history repeat itself now? And also, if it does repeat itself, will history repeat itself the exact same way? But more importantly, if history repeats itself, what should we do? Ano kayang maganda nating gawin? Or ano kayang dapat nating gawin? So, those are the questions that we want to answer in this presentation. And hopefully, we can come up with our market strategy from those answers. As many of you know, one of the approaches to study the market is technical analysis. And one of the three premises on which what we do in technical analysis is based on is history repeating itself. Pero bakit nga ba? Why do we think just because we saw it happen in the past, pwede ulit mangyari ngayon or in the future? According to John Murphy, who wrote the classic book Technical Analysis of the Financial Markets, technical analysis has a lot to do with the study of human psychology. And since the human psychology tends not to change, that provides a good probability that what happened in the past would happen again. Thus, the key to understanding what could happen in the future lies in a study of the past. And so, hopefully, what we'll present to you in this afternoon can help shape your strategy in the markets moving forward, just like how we hope we have guided you in the past. For instance, on February 9, 2019, during our Traders Playbook event, we asked this question: is the worst over, or is there more pain ahead? And we have shared our views based on our Elliott Wave methodology that the market, base case, can go to 6,059. Or in our bear case, we can go as low as 4,727. Note that we call that when the market was still at 8,060 on the day of that Traders Playbook event. And as we saw in February 2020, the market broke below the support of its year-long consolidation. Na-break din yung napakalaking bearish reversal pattern niya na tawag namin is head and shoulders. Sold down heavily, and on March 19, 2020, after marking the low at 4,039, the market closed at 4,623, around 2% lower pa compared to our bear case at 4,727. 2 trading days later, on March 23, 2020, we had our besties. So yung iba po sa inyo, baka nakapanood ng mga besties episodes namin, and I hope we have contributed somehow sa trading ninyo. Good thing na din na merong besties kasi because of the pandemic, we didn't have a Traders Playbook last year. So the besties episode on March 23, 2020 allowed us to guide you through our investing in times of crisis episode. At that time, the PSEI was at 4,743, 39% lower year-to-date, and really was at many of us would consider a bottom. No, the market was, and the individual stocks were cheap and too far from their usual numbers. So we proceeded with sharing what we think we should do in the market in times of crisis, and then ended up with some recommendations on how we can take advantage of the opportunities that the market was giving us. Kumbaga ba, nung 2019 playbook, we used what we saw during that time to sidestep the drop. No March 2020 naman, we used what we saw during that time and applied what we know to take advantage of the opportunities to make money. So, we offered several options for you. Pwedeng yung mga index trackers, kagaya ng FMETF or index mutual funds, or if you want to play it based on the babalik din yan principle, or in our jargon, mean reversion strategy, we offer different technical mean reversion portfolios based on how far the stock prices were compared to their 20-day, 50-day, and 200-day moving averages. And lastly, tinignan din natin yung mga magagandang stocks, mga blue chips, na sobrang bumagsak yung presyo, and their prices at that time can be considered really as a crisis level, yung sobrang mura na, sobrang bugbog, no? Bargain na bargain. And these are the performance of those portfolios. Assuming you bought it at the close on the next day after the besties, so 23 yung besties, March 24 ito, up to December 29, 2020. As you can see, these strategies, yung mga tinignan natin, yung mga ginawa natin, at yung mga napili nating stocks, based on the methods presented, can provide us good opportunity to earn from the market. Maybe not the best, no, but definitely worth our while. Ito naman yung mga performance nila as of Friday. In-update natin, February 19, no? Mag-anniversary na din pala yung 2020 low, no? At saka yung best days episode na yon. So, bakit natin dinidiscuss, no? Bakit natin dinidiscuss yung mga ginawa natin in the past? Well, bakit natin pinakita pa yung mga results, no? Yung mga nangyari sa mga strategies natin in the past? Again, if history repeats itself, baka kasi magamit natin sila ulit. If mangyari ulit yung mga nangyari dati, baka pwede natin ulit gawin yung mga ginawa natin dati. And maybe that can give us some probability to reap similar results. Okay? So ang tanong natin ngayon, ano ang nakikita natin sa market today? Diba, no? So here's the price chart of the PSEI. No? The entirety of it, from start to most recent. We noticed that what we saw in mostly the second half of the past decade, yung parang nagtatop yung market, and it was supported by this blue dotted trend line. There was support here, 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 and here. And then around February 2020, the PSEI broke below that support. And yun nga, made the 4,039 low on March 19. I know. From there, the market roared back. Ang lakas, no? But when we saw the market nearing the trend line, which used to be supporting it, parang nauuntog. Parang nahihirapan na siya umakyat. In technical analysis, we call that role reversal. Dating support, kapag nabasag, pwedeng maging resistance. And we have been seeing that in action for several months already. The thing is, yung nakita natin nung around 2013 to early 2020, mukhang parehas sa nakita natin nung around 1993 to around 1998. The market was also supported by a trend line. Bumagsak yung market and nabasag din yung support. And nung binalikan, the previous support acted as a resistance. And the market proceeded to go lower again. Aside from that, kung kanina, role reversal ng trend line ang nakita natin, this time, similar, role reversal din, but now it's the 50-month moving average that we saw which acted support, broken, and then became resistance for the market. So if we combine them, the trend line and the moving average, we have, tawag namin, no, confluence. No? Nagkakataon, pareho ang pinapakita nila, one giving the other more parang credibility. No? Then we look further, and we saw that when the market dropped from its 2018 high at around 9,078 to the 2020 low at around 4,039, tapos nag-bounce, looking at where we were several weeks back, yung range kung saan mukhang nahihirapan umakyat yung price, using the Fibonacci retracement tool, that area was around the 61.8% retracement of that drop from 9,078 to 4,039. And then, when we look at the past, when the market dropped from 3,447 high in February 1997 to 1,075 low in September 1998, nung nag-bounce siya, it also retraced 61.8% retracement of that drop. Nauntog, and then bumalik ulit pababa. So here, showing them all, no? Yung mga similarities of what we have been seeing in the market in the recent past and what happened in the 90s. The broken trend line support, which acted as resistance, the broken moving average support, which also acted as resistance, and the 61.8% Fibonacci retracement, which marked the end of the rally in 1999, which was followed by another more than 60% drop in the PSEI, which actually made a new low at that time. Yan. So to end, here are our key messages. Una, it seems that what we're seeing now, we saw this before, no? We have identified which part of history the market now seems to be repeating, and we definitely want to apply what we know about human psychology and technical analysis to have a sound strategy in the market. Again, if history repeats itself, as shown on the charts presented, the recovery we saw from March 19, 2020 might be similar to what we saw in September 1998 to around July 1999. Given that, again, if and only if history repeats itself. Pwedeng hindi mag-repeat ng history. Pero if it repeats itself, kung sakali na history repeats itself, then we have a clear idea that if the resistance points that we saw from the trend line, from the moving average, and from the Fibonacci retracement tool, if they are strong enough na harangan yung presyo, then 2021, we think, can possibly be similarly exciting like 2020. By exciting, we mean mukhang bababa pa. And if we know what to do, it can give us an opportunity to first, sidestep the drop, and then second, to take advantage of the recovery. Ayan, no? And finally, if history repeats itself, ano kaya ang magandang strategy? Now, this is where what we presented kanina might come in handy. Again, if what happened in the past happens again in the coming days, then we'll do what we did when those things happened in the past the next time it happens. Okay? So thank you very much for listening, and I hope we have contributed something useful this afternoon. Happy investing!
Thank you so much, Aaron. That was a very insightful presentation, and thank you for turning, some pain ahead into an opportunity, and also for making us feel that hindi naman sayang na na-miss out natin yung drop na yon. There might actually be opportunities to still be entering in the market. So again, everyone, I'm sure you guys have a lot of questions. Please don't hesitate to type them in the chat box. Again, we have some chat moderators. And of course, one last pop quiz before we start the panel discussion. Okay, guys, ready? Here is the question. This was said, by the way, the report of Sir Aaron. So, which classic chart pattern did we see prior to the big downtrend or the down move in 2020? Is it A, double top chart pattern, B, head and shoulders top, C, an ascending triangle, or D, cup and handle? So again, hopefully somebody or a few of you got 2 out of the 3 answers correctly, and the 3 lucky winners will be taking home 5,000 pesos worth of FMETF investment credits. And while you guys are still answering the quiz, sana naman nakuha niyo yung correct answer. Let's talk about what this price is exactly. This is, of course, the First Metro Philippine Equity Exchange Traded Fund, or FMETF. This is the first and only ETF in the Philippine market. What is it? Why is it so special? Let's watch this.
ETF stands for Exchange Traded Fund, a stock and mutual fund rolled into one. In ETF, money from different investors are pooled together to buy diversified stocks and securities. What makes ETF unique is that it can be bought and sold in the market just like any stock. And did you know that there's only one exchange-traded fund in the market today? Introducing the First Metro Philippine Equity Exchange-Traded Fund. First Metro Philippine Equity Exchange-Traded Fund is designed to track the Philippine Stock Exchange Index, or the PSEI. PSEI is a fixed basket of 30 common stocks across all sectors, carefully selected to represent the general movement of the Philippine economy. To put simply, when you invest in First Metro Philippine Equity Exchange-Traded Fund, you are investing in the top 30 Philippine stocks available today. Track the performance of PSEI through instant diversification in a transparent, flexible, and simple investment solution. First Metro Philippine Equity Exchange Traded Fund.
Okay, guys, again, if you got 2 of those pop quiz questions, so just 2 out of 3, you will have a chance to win 5,000 pesos FMETF investment credits. And we will try and announce the winners near the end of the program. You will be contacted for sure. Okay, guys, without further ado, we are now at the most anticipated part of the program, the panel discussion. Let's please welcome back to the screen our distinguished speakers. So welcome, gentlemen, and I think one woman will be joining us as well. So guys, a few days ago, we had also posted a contest on our Facebook page on what questions you would have for our speakers. So we will be selecting from that. Very, very challenging questions. Are you guys ready? And I've gotten a barrage of questions from the live stream. Okay, now since we came off that presentation of Aaron and Royce, it seems like one versus the other, diba? A chance to go down to 4,000 levels, a chance to go up to 8,600 levels. For Royce, what is better to be using? Stocks with good technical indicators, but not so much good fundamentals, or stocks with good fundamentals, but quite bad technicals right now?
Yeah. Okay. So, hello. Good afternoon, everyone. Okay. So for me, I think it's a matter of your it's a matter of your investment style, right? The question is, what's better, a stock with good technicals or a stock with good fundamentals? It depends on the style of the certain investor or trader. It depends on the investment horizon. But at the end of the day, it's all about risk management. Especially for those who are only basing on technical analysis, it's better than ever to always have risk management. So it depends on the opportunity that you would like to make use of. At least in our platform, we have report creators to both technicals and fundamentals. So it's better to just make use of it. And again, as mentioned, risk management is key to all kinds of investments.
Okay. Aaron, can you add to that? Syempre, it's good to, try and look at books, di ba? But in this time where we don't really know where the market's going to go, where would you be focusing?
Well, for me, ang lagi kong opinion talaga dyan is if you invest based on your style. You invest based on your style, you invest based on something you have tried before that worked, no? Kung sakaling may na-try ka before, hindi nag-work, then abandon that, no? Kung sakali na talagang you're more comfortable investing based on the business, no, or sabihin natin through valuation, then you stick with that, no? As long as you can somehow understand, no, what you are investing or getting into, no. But again, at the end of the day, para sa akin na at the end of the day, yun nga, tama yung sinabi, agree ako doon kay Royce na kahit na pumili ka ng either fundamentals ka, valuation based, or sabihin natin technicals ka, laging hindi mawawala yung risk management, no? And again, we have to accept when we are wrong. No, we have to accept when we are wrong. We have to accept when we are sabihin natin when the market goes against us, no? Kasi at the end of the day, capital natin 'yan. We have to protect that capital, no? So parang sabi ko nga, bawal lang pride, no? Bawal lang pride, no? Kung mali, you cut, no? Then you look for another opportunity.
Mm-hmm. Guys, let's take a step back here. And actually, what I'm wondering with the 3 presentations, parang iba-ibang tone, diba? You've got Sir Alvin, who I feel is the most realistic, pragmatist, diba? With the 3% base case GDP scenario growth. You've got Aaron who said there's opportunities pa kasi baka it might actually get worse. And you've got Royce. Royce, you are the most bullish here among the 3. What is your main reason for that? Can you please justify why it's quite divergent from the 2 speakers?
Yeah. So thank you. Yeah. So for us, I think for me and Dr. Ang, I think we have the same view that the worst is over. It's just that for us, for our team, we expect the economy and corporate earnings to recover stronger, faster than expected. So as mentioned earlier, number one, the response from the monetary and fiscal side is better than the past crises, right? And we have more catalysts ahead, like the Create Bill, and that is a catalyst specific to our country only. Another is there's room to reopen. Some government officials are still not keen on us going to MGCQ, but imagine 9 out of 17 mayors are already leaning towards an MGCQ, right? Compared to previous months that no mayors at all want to be under MGCQ. That's our first point, right? The second is again the vaccine. Okay, it may be delayed a bit, but for us, it's definitely the worst is over, and the vaccine is will come. The vaccine will come, and I guess what we are seeing here is at least if we vaccine the at least starting from the more populated where most economic activities are like Metro Manila, Metro Cebu, Metro Davao, Calabarzon. So once successful, that would allow for further reopening. So those are our catalysts. That's why we expect not only the economy but corporate earnings to recover. So as mentioned earlier, we have low base effects and we have catalysts there. So.
Okay, Prof. Ang, because Royce is sharing domestic-driven catalysts, right? And you had mentioned that we are 40% reliant on external catalysts that we have no control over. I have a question here from the floor. What would be the effects of a potential U.S. recession, or even just, I think a general global slower than expected recovery on, he asked the peso, but also the Philippine market in particular? What's the probability of this?
Well, the probability of the world is in a recession, right? So it's a question of what kind of recovery is shaping up, because some countries have recovered and then they're closing again. Like what's happening in Europe, and the U.S. actually is having that challenge right now because they actually did not close, but the requirement of adding more stimulus is like the debate right now in the U.S. Congress, right? How much can you really give so that the economy keeps afloat? So the same in that context, the challenge of the Philippines, since we are exposed 40% to any of these major trading partners that we have, is that a significant slowdown in any of them will more or less affect our value chain, and that affects our manufacturing. But having said that, that's beyond our control. So what really should be doing is really looking at the internal capacities that we have. So for that 60%, we should do the best that we can, and boost whatever we can boost out of the 60, so that we can find new markets out of it as well. So there are other countries that that are part of the value chain that are also dependent on other countries as well. So it's not like we're only focused on what we have as trading partners right now. For example, the DTI the other day had mentioned that they're asking for India for more exchanges, more trade, right? So this is like a spreading of the thinking that we are not just going to focus on our main partners right now. We have to look for other partners as well. So I think we really need to have like a forward-looking kind of mindset here. That yes, only 60% is in our hands, but we still can look for other markets that we can work together. Particularly those that are really moving ahead out of this pandemic. Look, for example, Chile, South America, for example.
Okay, so partner with those markets with a better recovery story, and also focus on the domestic economy, as Royce had mentioned. Now, I want to bring in Paul Michael Angelo here to talk about the property space, because this is one of your clearest picks, but this is also one of the biggest hit sectors when you talk about foot traffic, when you talk about offices just stopping with mobility here. So Paul, how can you defend that you are still bullish on this sector, and will this how long will this recovery actually take?
Yeah. Hi, my name is Paul Angelo. I'm the property analyst of FirstMetroSec Securities now. Yeah, pretty much when we look into the data as of 9 months of 2020, we can see that most of the segments in the property sector are doing well, except for the malls, of course. So let me give it blow by blow on a per segment basis, perhaps. So first, on the residential segment, of course, we see sales revenues have declined. But if you're going to look at it on the developer side, you can also see that the inventories also went down. So there is a perfect balance between the supply side going down because of the pandemic and the demand side the demand side were because of the pandemic, and the supply side because the developers also stopped construction activities. So, at least for the residential segment, we see that for 2021, as long as the developers would pick up from where they have started and continue building up new projects, soon developments, the supply side will have to catch up. Now, going to the office segment, we can see that offices segment have been resilient, and pretty much we're going to see the same level of resiliency for 2021. So for malls, our call would be for reopening. So of course, because of community travel restrictions, visitations on malls went down. But as you can see, as the quarantine restrictions eased, we can see people already braving the waters, already braving the streets, going to the malls, even the restaurants. So as soon as the rollout of the vaccine has begun, people will be braver to go out, and eventually malls will mall foot traffic will also be the same. And lastly, admittedly, hotel segment and the MICE activities will be back-ended in terms of recovery, but it will grow together with the tourism industry. So we expect growth there probably by late 2021 or early 2022.
Okay, thanks for those insights. I just want to throw the question to Professor Ang. Do you agree with this optimistic view on the property sector, especially when it comes to lease demand? And, it's not just about shutting down, we can't go to the malls, but also just changing the ways that we are working. Do you not see these trends and work from home to continue persisting through even after the pandemic, or these trends where you're teaching remotely and schools can do this indefinitely? When will these things come back to pre-COVID levels? And do you agree with the previous speaker?
Yeah, this is a very interesting point, because you're looking at the real estate sector. Our view is, if you're looking at it from a holistic perspective, it's not going to be recovering very quickly, because it's all dependent on consumer demand, right? And also producers doing more activity. So this is an unprecedented recession. The recessions we have had in the past, we can predict the severity or the opening or the recovery, because it's happening in a certain sector or a certain segment. This is a wholesale kind of a recession affecting both supply and demand. And that's why we are in our view, if you look at real estate, you're probably looking at which are having quick recoveries. Yeah, leasing, but there's need to be some conversion. So for example, malls will not have the retail space that they used to have before, but it's not that you're going to leave it at that. You have to repurpose them, make them, for example, logistic centers. You can make them warehouses and the like. So of course not the whole mall, but certain aspects of the mall can be done like that. And in the case of condominiums and other spaces, I think it's more of the mixed kind of properties that will have better continuity in this pandemic. For instance, we know that the pandemic will not stop even with the vaccine. There would still be like continuing need for protocols. So people would like to live very close to where they work. So those mixed properties will have better longer term lease. And relatedly, you have to convert some of these property spaces to where demand is more sustainable, because if you build the same focus kind of investments, then it will be targeting certain markets, right? And at this stage, you will have challenges doing that, because you want to pull everybody up at the same time to be able to benefit from that.
Okay, thank you, Prof, for those insights. Relatedly, there's this new type of asset to be investing in, which are REITs, that launched during the pandemic, actually last year. I'd like to call back Paul. Paul, what do you think about the REIT market during a pandemic, and how does this relate to the recovery story that you've been pitching, and also that Professor Ang is saying?
Yes. You can see, as for REITs, we see this as an opportunity for both the listing company and the general investor. Like, for example, the listing company, this will unlock the values of the properties that are listed in their portfolios, which in turn will also positively affect its parent company or grandparent company, or whatever, or whichever company it is. Then, as for the general investor, REITs offer dividend yields that are attractive. And for me, this is attractive, especially for this year, considering that we are currently in a low interest rate environment. So the potential price action and the yield will also give value to the general investor.
Okay, so it's actually something worth looking into, particularly during this period. I want to move over from property space into the financial sector. Of course, your Metro Bank, you can't really specify, but nevertheless, the FIST has just been passed into law by President Duterte. I want to ask Derek here, who is, of course, the expert when it comes to looking at certain banks. What will be the effect on these banks, especially since, even with the easing of the interest rates, a lot of liquidity in the sector, parang banks have still quite a high amount of risk aversion. Is this FIST going to be the catalyst that finally allows banks to spend, to lend, and consumers to spend?
First of all, thank you for that question. My name is Derek, and I'm part of the research group helping cover financials, economy, and telcos. I should first answer the question whether it's positive. Yes, of course, generally the FIST law should have a positive push on the investor sentiment. Just to reiterate what this law is all about, FIST basically allows banks or other financial institutions really to dispose their NPLs by selling them to specialized asset management companies. So all non-performing assets until December 22 can be sold to these special companies by the banks. Given the high NPLs last year experienced by the banks, no thanks to COVID-19, FIST will definitely alleviate some NPL pressures from the banks. We can also take note of what happened to FIST's predecessor bill. If you can recall, there's a Special Purpose Vehicle Act of 2002. NPLs then, because of the Asian financial crisis, went high. So the government enacted this law, and NPLs have since come down in 2002. But then again, we don't think that it will be as much needed, at least for the banks that we cover, because we believe that there will be limited upside in NPLs, at least for the banks that we cover, yung BPI and BDO. We can't recommend Metro Bank because we're part of the group. That's a result of the positive impact of Bayanihan 1 and 2 on the borrowers' liquidity management last year. FIST is good to have for these bigger banks. In the last year, major UKBs or universal and commercial banks reiterated that they did not avail of BSP's regulatory provisions, given they have a strong capital position already. BDO had 14.35, I think, and BPI had 17.7 in capital adequacy ratios. Again, provisioning by these larger banks help a lot in this case.
Okay, so the banks actually have what it takes with or without this FIST bill, but this, of course, helps the other ones that do need it. Dr. Ang, to what extent is this going to be beneficial when it comes to loan growth? And just relatedly, what other government initiatives are going to be market moving in the next few months?
Well, the FIST law definitely will help just like what Derek said, would relieve the pressure from banks from being conscious of loading more debts and lending. So that frees them from that concern, and that's really very important.
other things that the government needs to do that can move the market, well, of course, the rollout of the vaccine is very important. No, that gives like the it's like the base of your confidence right now. But more important, I think, is for overall confidence. Talking of not just the market but overall confidence is not seeing a plateauing of cases, but declining number of cases. That would really boost the market and not only and everyone's confidence, because that means we can really go back to economic activities. Having said that, then the government needs now to work very very well on using the resources it has in its arsenal. Actually, if you note that the Bayanihan 2 funds have not been fully used, and they have been extended till June. That means the government has money but is unable to, release it and use it to really pump prime the economy. So this is where you have the gap, and we need to see that that gap is going to be opened up only when there is economic activity, because very few firms right now will be able to benefit from that. No, they will not borrow even if they have the money is there for them to borrow, because they have no confidence. So this is like a domino effect. You have to do those two things very soon and decisively. The rollout of the vaccine and having and to see cases going down. And if you do that, then all of this money you have, combine the pent up demand of consumers that Royce was mentioning, you just can flood the confidence back into the market.
Okay, so it's also up to us to keep eating out and consuming, as you mentioned, to also pull out the demand. And speaking of consumption, I wanted to bring out Sophia Rodriguez here. There are a couple of questions on the consumer stocks in particular, and I think our audience wants to know your specific opinions here. I think Royce gave other stocks already. I have a couple of specific questions. One about JFC. This company, even before the pandemic, had been on an acquisition spree. A lot of eyes were on Smashburger and Coffee Bean. Now there's Yoshinoya. Is this a good move for you, especially during a pandemic, for this company to continue on that acquisition?
Okay, so good afternoon, everyone. I'm Sophia Rodriguez, part of the research team with consumers as my coverage. So I would like to talk about JFC as a whole first. So we think that with vaccine rollout plans in place and the further easing of restrictions, as Paul said earlier, more people are willing to brave the waters, eating out, traveling, spending, basically going out to enjoy and celebrate life. So we think this would mean more foot traffic and customers in restaurants, but fast food chains and the likes of JFC will show signs of recovery but could still lag behind. This is because consumers have been staying home, having deliveries, home-cooked food as their meals. So once they go out, we think they would probably prefer going to full-service restaurants over fast food chains for multiple reasons. Possibly them craving for a full dining experience for a change, opting for healthier alternatives, and see these establishments as safer options. So as for Yoshinoya, it's a fairly small store network, and it is a 50-50 joint venture. So it is a good move to contribute to JFC sales volumes and add to its diversity. And also, like they said, the menu is very suitable for deliveries, which JFC could leverage on. But we don't think it may make a very significant impact on earnings or exactly move the needle for now. We think JFC still has brands that require more attention first, mainly its Smashburger and CBTL business. So we expect those brands to recover and its profitability to reflect in JFC's earnings before its smaller ventures like Pho24, Panda Express, and Yoshinoya.
Okay, thank you for those insights, Pia. Can we move on to another stock, which is also very interesting, Mary Mart. Of course, that was stellar IPO. So many saying that it looks like the Amazon of the Philippines when you talk about the valuations. What are your insights on that? Is this valuation justifiable when you talk about consumption habits and whether that's going to be picking up for non-discretionary items?
Okay, so we saw Merrimart perform well for the 9 months ended in September 2020. So revenues actually increased by 28.3% year on year. They also expanded their network with 18 branches from just 3 in the same period last year. But as mentioned by Royce earlier, we've seen faster than expected normalization in essential spending. So in supermarkets and groceries to be exact. And this means that consumers stockpiling, panic buying, and focusing on essential items may taper as the economy reopens. So with that, we think Mary Mart will continue to be stable because people will still be buying groceries and etc. But it would be a challenge to surpass the performance of last year, given that the high base because of the surge in essential spending when lockdowns and stricter restrictions were in place. Perhaps for the technicals of Merrimart, I would pass to either Royce or Aaron, Sir Aaron.
So thank you, Pia, for that. Actually, for the technicals, if you take a look at the chart, Merrimart has been trading at a range between 6.35 and 8 pesos. So at current price of 7, if you are a trader or if you are an investor looking to pick up at or would like to add technicals to your arsenal, you can enter at current prices until 6.35 given the favorable risk to reward. But for me personally, I would cut my what I would is below 6 pesos. Personally, in terms of concept of technical analysis, you would cut below 6.35, right? But I would give a little more volatility, little more leeway for Merrimart given the volatility. So, uh, 6.35 to 8 is the range, cut below 6, and you
Okay.
can enter until 6.35.
Okay, so still some upside, but might not be as we saw last year. And while we have you, Royce, talk about Dito Telecom for a while here, and again whether those prospects can justify the valuations that it has. Is it on its way to become a blue chip stock?
Okay, well, when we define blue chip means you become part of the PSEI, the top 30. But I think we must discuss the requirements to be part of the PSEI, and let's discuss whether Dito passes it as of the moment. So number one, public float must be at least around 15%. Dito uh, is okay with that, given its public float of around, I believe, 66%. Next is it liquid enough? So the company must rank among, I believe, top 25% in median daily trade value. So for Dito, you have no problem in liquidity also. It's one of
Okay.
the top in terms of liquidity. But next one is full market cap. That's where Dito right now has to, I guess, in terms of share price, has to further rally. Because if you take a look at the full market cap of Dito, it's around 49 billion. And the lowest, I believe, if I'm not mistaken, the lowest full market cap in the PSEI right now is DMT, around 60 billion. So it needs Dito to rally around 20% more for it to be at least discussed. So, and it needs upside. And I believe the only catalyst for Dito right now is the approval of its audit, which afterwards it can already launch its operations. I believe that's the only catalyst, and in my opinion, after that main catalyst, I believe there can be a sell on news event after that initial rally. So bottom
Okay.
line, as mentioned earlier, risk management is key right now, given the sharp rally in Dito. So risk management is key. Look, in terms of blue chip, it's not yet on the horizon, but
Not yet on the horizon. Okay. But still, might be there, but you're waiting for some more fundamentals there to come through. Guys, we only have a few minutes for just last two questions for our panelists here. And I know that there was a lot of information, and hopefully, we can get in touch with you guys to have all of the information that you were giving, particularly on your house calls there. Now, just to end, Aaron, I like this question. What should be the proper mindset of a trader or investor at these times to have a winning portfolio? Is it, you said kasi parang there's an opportunity to still buy, di ba? But at the same time, Professor Ang said we need to save money, we need to be a little bit more cautious. I mean, so how can we balance being cautious, being optimistic, taking risks?
Well, again, my stance really, when it comes to investment or investor mindset, well, before you can have your own or be firm with something, you have to know it, no? So, kung ako talaga, you have to have a method really to how to approach the market and you stick with that. No, you stick with that. So in my case, I have been sticking with my method, no, and my method has guided me again in the past to be able to sidestep the drop, no, and guided me again in March 2020 to take advantage of the rally, no. But my method now is telling me that there's really a possibility that baka mauntog na tayo dito. No, actually, we have, no, we have been experiencing strong resistance at around 7,400. And I think, no, again, if history would repeat itself, I think there's really a good chance for it to go down. Actually, if we look at the charts, no, if we look at the charts, me personally, again, I'm a financial person, no, so I also do my fundamental analysis. Medyo nahihirapan din akong ma-convince na baka bumaba ulit eh. Kasi syempre, recovery year talaga eh. I mean, we have been down so much. We have been battered, no, both on the economic, financial, among others, no. But then again, when we look at the past, no, and we have been guided by it, kaya tayo nakaiwas sa drop, kaya tayo naka-take advantage ng rally. Maybe, just maybe, no, at least for myself, no, just maybe we can keep that in mind, no. There are a lot of reason to be optimistic about the economy, no, and again, we should be optimistic about the economy, however it would turn out to be, no. But then again, if we talk about the stock market, the warning signs are there. Again, the U.S. is still roaring, no, meteoric heights, no. So I think there's a good chance that if the music stops, especially in the global market, no, in major in the markets of major economies, then possibly that could be a catalyst for a not so good time in the stock market.
All right. And finally, just to close, Professor Ang, I like this question. It was actually addressed to our traders and researchers here, but I'll throw it to you. You have an audience now of 1,500 traders, many very young, in a demographic and age bracket that's getting younger and younger. This is a nice question. In this rebuild phase we are currently at, how can a retail trader or investor help or contribute to the recovery of the economy?
Well, that's a very good question, because right now there's as I mentioned in my presentation, there's a lot of excess cash, particularly A and B class right now, because there's no way to go with that money, unable to travel, unable to shop, unable to go out and consume. So there's excess cash, and that excess cash can do a lot if it's invested in something that is going to contribute to create jobs directly and going to produce economic activity domestically. If we're looking at, there's a lot of opportunities outside the Philippines and other kinds of investment that are, at this point are like what Aaron said earlier. A lot of them you're going to be considering the fundamentals really. Right now, in an unprecedented recession, you have to look at the fundamentals. You need to know the landing space, because if you're launching into space and you don't know what is it that you're going into, I think that's the challenge of many options available to us right now, because we can go as far as things we don't really know, but things that are moving, So it stays to be on guard by doing good research, doing good fundamentals, knowing very well your technicals, knowing very well the companies, knowing that these companies are producing something, creating physical goods or doing services that people actually buy. Value-based investing is the most important, and we will be very traditional here, Aaron and Royce. Very traditional. We have to be value-based investing, looking at physical and something that we can account for, and not just air. And that has been the lessons of recessions that were not caused by pandemic. Recessions that caused in the U.S. in the 2008-2009 global financial crisis, the Asian financial crisis. So we really need to be grounded. But we really need to be hopeful also, and this is an opportunity for you young traders to be involved. in at some point it can be called some kind of a patriotic investing, right?
Thank you so much for that. So back to basics, look at the data, do your research, study. It doesn't, money doesn't grow on trees. It's definitely something that you need to practice and really know what you're doing, especially as you mentioned, these are all very much linked to the number of jobs, very much linked to our real economy. So thank you so much for those insights. Thank you guys for participating. Thank you for all the very incisive questions. And now, guys, let us proceed to the grand raffle promo. Okay, so we have investment certificates and EGCs from our fund partners. So these are First Metro Asset Management, BPI Investment Management, Sun Life Asset Management, ATR Asset Management, and Phil Equity Management. Thank you guys for sponsoring this event. So we will be giving away the following prizes. 5 winners will get 1,000 pesos of Atram investment certificates. Very exciting. Another set of 5 winners will get 1,000 FAMI investment certificates. And then you've got 2 winners of 1,000 pesos each Sun Life investment certificates, 2 winners of 1,000 pesos Phil Equity investment certificates, and 1 winner of 5,000 gift-away EGC courtesy of BPI Investment Management. And in total, guys, we will be drawing 15 lucky winners who will get to, kickstart their investments or at least add to their portfolio, and the winners will be announced shortly. But do wait for our email on how to claim our prize. Okay. And while the raffle is ongoing, let me see if I actually have the names of the winners. I don't think I have that right now. We will get our team to contact you directly. Let me see. Okay, but nevertheless, congratulations to our winners. Now note, guys, just to be clear, here they are. Okay, congratulations, Ronaldo Lejano. Okay, Ronaldo Lejano, congratulations. You can see your name on your screen. Henson Ang Milasi. There you go. So we've got 3 so far. I think these are our 3 winners, no? Okay, so again, guys, if you want to claim your prize, you of course need to have a FirstMetroSec account. And again, if you don't have one yet, go to www.firstmetrosec.com.ph. Apply completely online. Very, very easy. The account opening can be done from Monday to Friday, 12 midnight until 2 p.m. Philippine time only. So again, we have to stress that it's right now currently limited to Metrobank holders, but you can use the code TP2021 when you're asked the question, how did you learn about us, to proceed even if you don't have a Metrobank account. So again, that's TP2021, so don't miss out on that opportunity. And let's see whether we have the grand raffle prizes, guys. I'm waiting. Winners will be flashed on the screen in just a few seconds. Okay, not sure we have all the time to draw out our winners, but nevertheless, congratulations to all of our winners. Okay, ladies and gentlemen, we are almost at the end of our program, and to give his closing remarks, let us all please welcome Mr. Gonzalo G. Ordonez. He is the president of FirstMetroSec.
Good afternoon. Thank you all for joining this briefing. I'd like to take this opportunity to thank our guest speaker, Dr. Alvin Ang from the Ateneo de Manila University, who generously shared his time and his insights. Dr. Ang was able to provide us with a valuable perspective from someone who is an academe, a government advisor, and an avid watcher of the markets. I'd also like to thank our wonderful host, Ms. Daniela Laurel of One News, for livening up this event with her grace, charm, and wit. Let me attempt to briefly summarize the broad themes which came up in today's briefing. Our speakers are seeing early signs of economic recovery with the easing of restrictions and people gradually resuming their pre-COVID activities. Many sectors are already showing some improvement. The pace of recovery is expected to accelerate throughout the year as market confidence returns with the vaccine rollout and decline of COVID-19 cases. We are optimistic about the current situation and excited about the prospect of a strong market recovery. This is why we continue to invest in new features and functionalities that will allow you, our customers, to quickly refine and adapt your trading strategies to fast-changing market conditions. This week, we quietly introduced Limited Touched, or the LIT order type in our Pro platform, to add to your arsenal of trading tools. Google FirstMetroSec Limited Touched and find out more about this exciting feature. We have been hearing many of your ideas from social media and various other channels. We hear you. We have used Pro as our inspiration to reinvent the standard website. We will continue to enhance this with the other features that you expect. So next, we will focus on enhancing Pro. There are so many features coming up for Pro that the differentiation between Pro and the new standard site will again become clear. Of course, we won't stop there. The roadmap is exciting. We want FirstMetroSec to be the best platform for our clients, the best in the Philippines, arguably the best in the region, and definitely better than ourselves today. With that, I would like to thank all of you again for coming. We hope to see you at our next market briefing.
All right, guys. So we have the winners of all of our different investment certificates. You can see that on your screens there. It's rolling right now. So please pay attention. You will be seeing whether you've won, and we will be contacting you very, very quickly via email. So again, congratulations to all of our winners. I hope it was worth your time to join us today. Personally, I've learned quite a lot. And on behalf of First Metro Securities, we would like to thank you guys for spending your Sunday afternoon here with us. We hope that you not only learned a lot, but also enjoyed, and that this will be beneficial for you. You can hit the ground running on your trades. This has been Daniela Laurel, and it has been my real honor to host this year's Traders Playbook, the biggest virtual briefing of FirstMetroSec. And wherever you guys are joining us from all around the globe, good afternoon, good morning, and good night. With First Metro Securities, it's #YourFutureFirst.